evening, everyone. On behalf of Indian Business and Professional Council Dubai, a warm welcome to all of you. To begin with this session, please welcome our chairman, Mr. Suresh Kumar, for the opening remarks. Thank you.
Dear members and distinguished guests, welcome to all of you. Greetings, and I hope all of you are keeping well and safe. Today, we have not just a distinguished audience, but an excellent and versatile speaker in Mr. Dinesh Kanabar, whom our AAA group led by Mr. Naveen Sharma has invited very topically, very timely invitation to discuss a subject which I mentioned recently has been of late agitating the minds of many NRIs. But this is something that we have now got used to because usually Government of India looks at the landscape on a much broader basis, not just the GCC-based NRIs, but also across the world. And there are, rightly or wrongly, some NRIs that are like the shipping. In the shipping industry, you have flags of convenience. So there are many NRIs that are convenient NRIs for the purpose of tax minimization or optimization, to put it mildly, or tax avoidance, to put it bluntly. It's a subject which I think needs clarity, and I'm sure after today's discussions and based on your views, questions, and Mr. Dinesh Kanabar's answers and responses, we will also take it appropriately with the Government of India through the right quarters. That is something that IBPC and AAA Focus Group and our NRI Affairs Forum as well can take it up strongly here. So I'm glad that we have an eminent expert in the nature of Dinesh Kanabar, whom I have known. He is very well known and well respected in the professional and financial circles in India. But without further ado, let me hand over the evening's sessions to steer it to Mr. Naveen Sharma. Naveen, over to you.
Thank you, sir. Thank you very much. Income tax, NRI, and now we all are debating whether we have to pay tax on our global income or not. This is the subject in one way or the another in the mind of the NRI world over, more specifically in the Gulf, because we have no clear answer whether this is a zero tax country or no tax country, or 120 days now or 180 days rental income, etc., etc. And we are fortunate to have with us Dinesh Kanabar Sahab, who is expert in income tax. He is the Chief Executive Officer at WTS Durva Consultant. Everybody is aware about the contribution he has made in the taxation field. More later, even in the VAT practice. Mr. Dinesh is the winner of Asia Tax Practice Leader of the Year 2020. He is a stalwart in the industry and has over the decades recognized as one of the most leading tax practitioner in India and Middle East. Previously, he was the Deputy CEO of KPMG India, and he specifically said, Naveen, do not go overboard in introducing, but he is a member of the National Executive Committee of FICCI, and he is currently a member of FICCI Committee on Taxation. I will not take much of your time, and now invite CA Dinesh Kanabar Sahab to address all of us. Just one note that we have circulated the Google form, and we have the questions with us, which we have forwarded to Shri Dinesh Kanavarji. So he is aware about the question which has been given. Even then, if you have any more questions, please, you can write in the Q&A, or even email to us, or you can update the Google form. If the time permit, we will request Mr. Dinesh sir to take the questions also. Over to you, sir.
Thank you, and a very good evening, ladies and gentlemen, and thank you for joining us this evening to talk about the changes that have come about in the tax residency rules. I am grateful to Mr. Suresh Kumar, Mr. Sharma, Sibi for this opportunity. And I do look forward to clarifying what are the changes that have been brought about, what do they mean to each one of you, and what do you take away from these changes? What are the things that you need to be worried about? What are the things that you can do to mitigate any potential exposure? Let me first begin with a general comment before I go to the specific changes that have been brought about. Of late, there has been a new tendency with the government of India is doing, and there is something which is very, very unusual. So every year we have the finance bill, which is part of the budget, and the finance bill contains say 30, 40, 50, 60 changes. Those are put in the public domain, people comment on it, and then the government, after hearing everybody, makes some changes to that, and then it is converted into a finance act, which then becomes the act applicable for next year. It is very rare, if at all ever, that there are changes made to the finance bill by adding new clauses which were not there, because there was no occasion for anybody to debate them, etc. This trend began last year when, for the first time, when the finance bill was being converted into Finance Act, the government introduced equalization levy. And equally this year, when the finance bill became a Finance Act, the government introduced many, many more changes to the tax laws. And one of the changes was the definition of the term liable to tax, which was different from what was there in the rules. And the reason why this trend is a little bit worrying, a little bit disturbing, is that when the finance bill is being enacted, actually the finance minister just gets up, says, I'm moving the following amendments to the finance bill. And in the next couple of hours, the bill is passed. There is no debate, there is no discussion, views are not sought. The drafting very often is very, very poor. In fact, just today, somebody noticed some errors in drafting, and therefore a corrigendum was brought about to make some changes, which is not a very, very happy state of affairs. And I would wish that going forward, the government is free to make whatever changes, but the changes have to be brought about in the bill, debated, and then the government, of course, has its own power to make whatever changes it wants to. But let me first begin to tell you, and of course, all of you know this. The only reason I'm putting this slide is so that we have a context what we are talking about, and then we can take it from there. So, as you know, the taxability of a person in India depends on the residential status, and we'll just come to in a minute as to what are the different types of residency and what are the tax implications of it. But just to explain very, very briefly, a person is regarded as a resident of India if the stay in India is more than 182 days and the person has spent either 60 days in that year or 365 days or more in the preceding 4 years. Then a person is normally regarded as a resident of India. This period of 60 days is expanded to 182 days when a person leaves India for employment. And that is something which we need to always keep in mind, that for a person leaving India for employment, it's 182 days. And whether the person has income of less or more than 15 lakhs is of no consequence. And we then have a change which was brought about in the last budget, which was to say that an Indian citizen or a person of Indian origin who has income in India of more than 15 lakhs of rupees, rupees 1.5 million, who comes to India on a visit, if the stay in India exceeds 120 days, then a person will be regarded as a resident. So this is the provision which came in last, and in any change that we talk about now as we go ahead, this is one change we need to keep at the back of our mind. Second is that a person may be resident, but a person may not be ordinarily resident in India under certain circumstances, which is that A, the stay in India is more than 120 days, but less than 182 days, and the income is less than 1.5 million. Second is the deemed resident new rule, which we'll discuss a little bit later. And a person who has been a non-resident in 9 out of 10 preceding year, or who stay in India in the 7 earlier years, is less than 729 days. In such an event, a person is regarded as a not ordinarily resident. And the simple implication is that if you are a resident and an ordinarily resident, then your worldwide income is liable to tax in India. If you are resident but not ordinarily resident, and this is something which you need to focus on and we'll be spending quite some time as we go ahead, is that your foreign source income is not liable to tax in India. It's only your Indian income which is liable to tax in India, unless there is a foreign source income which is derived from a business controlled or a profession which is set up in India. So, and of course, if you are a non-resident, it is only your India source income which is liable to tax in India. So as such, if you see the distinction between not ordinarily resident and non-resident, in both cases, it is only India source income which is liable to tax in India. So, however, that if you are a not ordinarily resident, then your foreign income, to the extent that it is derived from a business control or a profession set up in India, is also liable to tax in India. Very vital distinction, and I would urge you to keep it in mind as we go ahead, because number of questions that we have received are really answerable just on the basis of this one particular slide. Now, what is the amendment which was brought about last year, and what is the further amendment which came in this year? So the amendment was that a person is deemed to be a resident in India if all the following conditions are met, and this is in the context of an individual, that he is a citizen of India, his income in India exceeds rupees 15 lakhs, and he is not liable to tax in any country by reason of his domicile, residence, and other similar criteria. Just to focus, it is not really payment of tax on a source which makes you liable. So for example, UAE of course does not have tax, but let's say that a person pays taxes in UK because a person has got some source of income there. You cannot say that you are a tax resident of UK. You have to be liable to tax, and that liability should arise by reason of your domicile, which means that virtually your global income should be liable to tax in that country and not merely source-based income. And if all these conditions are fulfilled, then a person will be deemed to be a resident. But it does not mean that straight away your global income becomes liable to tax in India. As we discussed earlier, if you are a resident but not ordinarily resident, for which we discussed the criteria earlier, then your foreign source income is taxable only if it is derived from a business control or a profession set up in India. So any other income, so for example, as Mr. Sharma was talking about, whether it is overseas rent, interest, etc., unless it is derived from a business which is controlled or a profession which is set up in India, there is no liability to tax in India if you happen to be a not ordinarily resident. If, however, you become a resident because you do not meet the criteria of being a not ordinary resident, so for example, if in the preceding 9 out of 10 years you are not a non-resident, or 7 out of 10 preceding years your stay in India was more than 729 days, then you would become a resident. And if you became a resident, then you would be liable to tax in India on your global income. Very clearly, if just for a period of 2 or 3 years you have been a non-resident, then you are unlikely to have been violating the 9 out of 10 preceding years. And generally speaking, not always, but most likely in 99% of the cases, once you have violated these conditions, you would be regarded as a resident, but not ordinary resident, and not as a resident. And therefore, your income liable to tax in India will be income which is controlled from a business, which is controlled from India, a profession which is controlled from India, not any other income. Why is this amendment brought about? And I think this is very, very important to understand. This amendment is not to increase the tax base of the country. This has been brought about as an anti-abuse provision. And let me explain to you what do I mean. So there are people who are not resident of any country, and I know several such people. They might stay in Bahamas, and they might actually be working in USA because it's just a short flight. They are not tax residents of USA. They are not tax resident in any other country, and they happen to be citizens of India. And what India comes back to say is that if you are a citizen of India, or you are a person of Indian, or you hold a PIO card, then obviously you are doing it because you regard yourself as getting some benefit out of it. Otherwise, you would have surrendered that citizenship, become a citizen elsewhere. And if thereafter you just happen to be stateless, and again, Mr. Sharma made a very interesting and a very nice point to say that there are people who are becoming non-resident only for tax purposes. So the point in such a case is that if that's what you are, then you are liable to tax in India because you are not paying tax in any other country. Unless you become a not ordinary resident, then your foreign income, which is from a business setup or business control from India, would be liable to tax in India. So generally speaking, Indian citizens who are residing in the UAE will be regarded as a resident, but not ordinary resident if they contravene the conditions, and they will not, because they are not liable to tax in UAE. Now, let me also explain to you that the word liable to tax actually is there in every tax treaty which India has entered into. So to qualify to be a resident of a particular country, when it comes to determining the tax treaty, you are regarded as a resident of a particular country of a contracting state only if you are liable to tax in that particular country and not otherwise. The issue with regard to UAE was that because there is no liability to tax, it is only your period of stay, which has now been accepted. And of course, there are consequences which will come out of it as to what happens if your stay is less than 183 days, and we'll come to that in a moment. But it's just important that as the finance ministry has clarified, and that clarification has a basis in law, it is not just a wish list. Your salary income, your interest income, which is received in the UAE, continues to remain non-taxable in India. Your India source income will be liable to tax in India, which in any event applies even if you are a non-resident. So if, for example, you are deriving interest in India, not on NRE account, but on NRO account, if you derive rent in India, if you get dividends in India, all of those will continue to be liable to be taxed in India, because irrespective of whether you are a resident, a not ordinary resident, or a non-resident, all of those are liable to tax in India. There is no escaping, unless, of course, tax treaty grants you any benefit, which of course will be available to everybody. So as I explained, India source income taxable, which was always the case. Foreign source income is not liable to tax in India, unless again it's business income which is derived from a business which is controlled, or a profession which is set up in India. And I'll tell you why this might not be as preposterous as it seems. In the recent past, for a variety of reasons, right, wrong, and I'm not commenting on the merits of those decisions, people leave India just to become a non-resident because they've got some tax or whatever else, and they continue to have businesses, and they control those businesses from India, because when they are in India, they are actually running that businesses. So if you are now a not ordinary resident, then such income which is derived from a business which is controlled, or a profession which is set up in India, would be liable to tax in India, even if you are a resident but not ordinary resident. Therefore, for example, if a person is not a resident but not ordinary resident, and business is carried on in the UAE, either in proprietorship or in partnership, and that is of course controlled from India, then such income would be liable to tax in India. And of course, one would then need to see, Can one corporatize such a business? So if, for example, you do have such a business in the UAE, would you really corporatize and then demonstrate that the board of directors are the one who are controlling the business? It is not being controlled from India. The board comprises of a right set of people. The place of effective management is not in India. And therefore, although your status is no longer non-resident, you are not ordinary resident now because you happen to be a resident of a country which does not have, where you are not liable to tax. You would not have a problem if you are able to demonstrate that the income which you derive is not from a business which is controlled or a profession which is set up in India. Let me move to one other issue which has been a matter of considerable concern. Thanks to pandemic, people are stuck in various countries, are unable to travel unless there is a bio bubble and flights are permitted. To our knowledge, again, we know of hundreds and thousands of people who are stuck in India, who are unable to leave and have spent more than 182 days, 120 days in India, primarily on account of pandemic and nothing else. Most countries in the world have come out with relaxation to say that if you are unable to leave that country on account of pandemic, then that stay will not be taken into account in determining your residential status. India came out with a circular way back in May 2020, where certain very small minor concessions were made. One was on account of inability to depart India, and inability to depart would mean that there are no flights at all, anything, etc., due to pandemic and quarantine restrictions. And then a number of representations were made to the government of India that they need to relook at those requirements. And it was very, very widely expected that when the budget was presented, they would come out with provisions which would take away the rigors of residence only where people are in India on account of their inability to leave the country. Unfortunately, no such thing happened. I remember as on the managing committee of FICCI, I had an opportunity to interact with the finance minister and the revenue secretary. And I raised this question that India is totally an outlier as being one of those only countries which has not relaxed the residency rules for people who are staying in India on account of pandemic. And they said, oh, we'll come out with it very, very soon. It does not require amendment to law. We'll come out with a circular. Nothing happened. Again, as you are aware, an NRI approved the Supreme Court. The Supreme Court asked CBDT to look at it. CBDT came out with a circular which didn't do anything at all. And now the Supreme Court has once again been approached for a blanket exemption, and the matter is for hearing on 16th of April. So we'll need to see how does that happen. But those are the basic changes which have been brought about. Finally, just the term liable to tax, which was amended in this particular Finance Act, says a person will be regarded as liable to tax in relation to a country where there is an income tax liability on such person under the laws of that country for the time being in force, and will include a person who has subsequently been exempted from such liability under the laws of that country. So UAE clearly does not have an income tax liability on individual. There is no law. There is law on corporate taxes which has not been enforced. But insofar as individuals are concerned, there is no law which levies income tax liability, and therefore residents of UAE will fall within the mischief. So there was the brief presentation which I wanted to make. We can now go on to the question and answer that we wanted to take up.
Hi, sir. So thank you very much. You have also clarified a lot of questions already, but we have a lot of other questions as well. But before we take up the question, I would like to acknowledge the presence of Mr. Bipul Kothari, who is head of GITO. The GITO is an organization of Jain Business and Professional Group, and Mr. Bipul and his members are also attending it. And I also acknowledge the presence of Mr. Sanjay Mehta. Mr. Sanjay Mehta is the founder of Sadhu Vama, which is also the organization of the like-minded business people. I will start with the first question. although we have shared with you, NRI who has interest income, capital gain, or dividend income from NRE account is liable to pay tax if it exceeds 15 lakhs limit specified. So one common question among is, if we are just for 30-40 days and we are doing a business and having an income of say 2 million dirham in India, do we need to pay tax? We are controlling everything from Dubai.
So two separate, that question, Navinji, has got multiple facets. First, there is a reference to NRE account. Income arising in an NRE account, so interest on an NRE account, for example, is not liable to tax under the domestic law under Section 10. So Section 10 specifically provides that if a person is non-resident under FEMA, any interest arising on an NRE account is not liable to tax. That has nothing to do with the Income Tax Act at all.
Okay.
So that's the first provision we need to be alive to, and therefore that income is not liable to tax. Any dividend which arises in India, any rent which arises in India, was in any case liable to tax in India. And nothing has changed as a result of the amendment which has been brought about. So to answer your question very specifically, if a person is in India for 30-40 days, whatever, first of all, the new changes don't apply at all. You are not breaking sort of the test at all. And the mere fact that you have got income of more than 15 lakhs, you still become only a not ordinarily resident. Okay? Even assuming that the provisions of the tax treaty don't, so you can look at two situations. One is a situation that you are in Dubai for more than 182 days, and therefore you are a resident of Dubai, and therefore the treaty applies. Other is for whatever reason you are traveling globally, and you are in Dubai only for say 100 days. Then what happens? So whether or not you are a resident liable to tax in or eligible for UAE India tax treaty, doesn't matter. The answers don't change. Your India source income is liable to tax in India. That does not include NRE income, because NRE income is specifically exempted from income tax under IT Act itself. It does not require any tax treaty provisions. Your foreign income is not liable to tax in India unless, as I explained, it is from a business which is controlled from India or a profession which is set up in India.
So just I rephrase your question in a very common and simple language. If someone is doing business in Dubai and earning an income of say 20 lakhs rupees, in that situation, it's not liable to pay. He is not liable to pay any income tax in India, because what people are thinking, that salary income is exempt, but business income, he is doing business in the UAE, and so it's not liable to pay tax because he's controlling from Dubai.
That's right. So unless it is demonstrated that the business is controlled from India or the profession is set up in India, there is no change whatsoever. And if at all a person is spending enough time in India, as would demonstrate that maybe there is a control from India, then the best thing might be to corporatize that business, make it into a company form, appoint a proper board so that one can demonstrate that shareholding is not important. The day-to-day management is important. The management of the company invests with the board, and if there is a proper board, then it doesn't really matter. So you could be the CEO of a company, but that does not mean that the business is controlled from India, because the board and the CEO reports to the board.
So there is one question, and he's eagerly looking for the answer. Our member, Anjay Mehnod. Most common question for all NRIs. At some point of time, all NRIs will go back to India and become resident. Please suggest prudent methods, ways of tax planning in order that we can minimize our tax burden when we live only on our investment savings income and also do not face any tax issues. So I think you want to avail your services. I will say.
I'll be happy to answer that question, except that there is nothing which has happened under the changes, which changes my response to that. So there is no amendment which has been brought about this year which changes the answer. But generally speaking, when I deal with this question ever so often, when somebody is relocating from UAE into India, And the question is my overseas income liable to tax in India? And the question arises from two perspectives. If you become a global resident and the income arises to you individually, is that income liable to tax? First, we should be very sure that the income which has been earned overseas, that never becomes liable to tax. It's a question of interest or any other dividend income or capital gains on such income, which could become liable to tax in India when you become a resident. And one of the most common things which is done really is to set up a trust and a company underneath it. To go back and say that the income is arising to a company, the company may or may not declare a dividend, and that dividend may or may not be received by the trust, and when received could be distributed in any other year. And if one is able to structure that right, then that income, even when distributed by the trust and received by a person who has thereafter, so a person has come to India, has now spent 5 years, he has become an ordinary resident, no interpretation issues whatsoever. Even then, any distribution by an overseas trust, unless it is of an income which has arisen to the trust in that year, will not be liable to tax in India. However, there are a number of things which come into play. Number one, is that company to whom income is arising having a place of effective management in India? If the place of effective management of that company is in India, then that company itself is regarded as a resident of India, and the income of that company will be liable to tax in India.
Okay.
And how do you ensure that a company which is totally owned by you, you have become a resident, there is no foreigner, can still be regarded as not being managed from India? And there are a number of things one can do in and around that. So, for example, if bulk of your income is passive income on account of investments in mutual funds or whatever else, can you appoint an investment manager and say that the entire management of the funds is with the manager? And again, I'm not giving you specific answers. Each fact is very, very different. Again, when you look at an overseas trust, many times I have seen people make some cardinal errors, Navinji, that they do not ensure that there is at least one non-resident beneficiary. So, for example, if a person has relocated to India, wife, children, everybody is a resident of India, and they are the beneficiaries of an overseas trust. If that is the situation, there is a potential liability that that trust will be regarded as a resident of India. So can you create a charity as a beneficiary? So number of things which need to be taken into account. And if they are done, then it indeed is very, very possible to ensure that after you have returned from India, the income on overseas asset is not liable to tax in India. Indeed, once you become a resident, a disclosure is required to be made in the income tax return. If you happen to be a beneficiary, protector, trustee of any, all those disclosures are required to be made. But your income ought not to be liable to tax in India if those precautions have been taken.
So we have to plan. This is a proper planning is required, and I think thank you very much for highlighting it. And I'm sure when we will open for our members the Q&A, there will be more question on it. But there is one supplementary question which is attached. What are the benefits of tax residency certificate from UAE, and what kind of cost is involved, and what are the benefits?
No, so a tax residence certificate is not a question of a benefit. A tax residence certificate is a prerequisite under the Indian Income Tax Act. There is a very specific provision that India will enter into tax treaties, and a person who is a resident of an overseas country with which India has a tax treaty will be governed by the provisions of the treaty or the Income Tax Act, whichever is more beneficial. So that is an established position in law, no controversy, no shades of gray, etc. But if you say that I am a resident of a particular foreign country and therefore entitled to benefits of the tax treaty, that has to be certified by the tax authorities of that country, and they have to issue to you a tax residence certificate. So a tax residence certificate certifies your entitlement to be a tax resident of a foreign country. and thereby making you eligible to the benefits of the tax treaty.
Okay. And there is one question from Priyanka Gupta. What is the advantage of buying property in India with NRI funds? How many should you buy to take advantage of optimal taxable income from property? So is there any benefit if you buy a property from NRI account, NRE account or NRO account? Is there any particular benefit?
So the answer is clearly that the repatriability at the time of sale. So if, for example, you have bought a property, Navinji, from an NRO account, then when you sell that property, the proceeds will go to the NRO account. And while even if it is an NRO account, your your rental income, etc., will be eligible for repatriation. If you have bought from an overseas remittance and you are not violating any of those conditions, you are not trading in real estate, etc., then when you sell, you can take the money back. I don't think there is any tax optimization either which way.
Yeah. And the 15 lakhs limit about the Indian income. So if I'm living in Dubai and then I'm investing in the Indian stock exchange and I have made capital gain tax and I have invested through the NRE routes. So that is not part of the total 15 lakhs. So I have say 12 lakhs income from the Indian source and I have invested in the Indian stock exchange and I made 1 crore rupees from the NRE. So that will not be considered 15 lakhs, right?
No, of course it will be considered. It is the interest on NRE account which is not liable. Just because you make an investment using an NRE account, it's your India source income. You are a foreign resident. Your Indian source income is more than 15 lakhs. The capital gains of 1 crore made by you is indeed liable, and therefore income in India is more than 15 lakhs.
So if I have the capital gain on the stock exchange which I invested through the NRE route,
is liable to tax in India.
Liable to tax in India, but it will not be part of this 15 lakhs route, which is a new definition which come. That if
unless I stand corrected, Ajay, Saurabh, any comments there?
No, sir. It will be included in the computation of the 15 lakh threshold because that is an India sourced income. There is no challenge to that.
And then I will take a step down further. I am a salaried employee, and I am made. I'm a salaried employee, which is exempt from this 15 lakhs, and I have made 25 lakhs as a capital gain. So I am completely exempt because of my because I'm on a salary.
I think all of this is, I don't know what is this hair splitting out. If you have income in India, which is more than 15 lakhs, okay, and you are a resident of UAE, you get covered into resident but not ordinary resident straight away.
Understood. Okay, straight away. Good, sir.
Whereas if you take interest income on NRE account, it is not income, it is not regarded as income because section 10 says certain income is not regarded as income at all.
Okay, so, now there is one question from Mr. Vimal Pitalia. Will India new tax change will lead to the GCC wide tax reforms? Do you feel that GCC has to change the taxation laws or it will remain the same?
I thought, Navinji, you and the other people on that side of the screen are better equipped to answer that. I must say, on a very jocular note, I did hear somebody to come back and say, maybe UAE should introduce at least a 1% tax on all individuals, and then they will be liable to tax. But as I explained earlier, whether GCC countries will or will not impose tax on corporates, on individuals, is a very open question. There have been, for example, if I recollect right, Oman has introduced a new tax on individuals for the first time on high net worth individuals. Other GCC countries have corporate tax but not individual tax. Saudi has got its own zakat and whatever else. So different countries are following different models. Bahrain, UAE are on, Qatar are on one side. Qatar again has got income tax for corporates. So it's a more wider economic question. And I would very much doubt as to whether the changes which have been made by India will weigh one way or the other in the minds of the GCC authorities in levying tax on people. As I explained, I think this is very important for me to reiterate, Navinji, that India's tax changes is not to expand the tax base and bring everybody into tax net. As at 99.99% of the people would become resident but not ordinary resident. Therefore, the only challenge that they have is in respect of a business which is controlled from India or a profession which is set up in India. And again, there again, one can look at corporatizing. So I don't think practically it impacts anybody. It is meant to be an anti-abuse provision for people who want to be stateless.
Got it, sir. Well, Mr. Ramaswamy Ganpati, he has asked one question. If income in India exceeds 15 lakhs in financial year 21-22, and am I liable to pay tax on my salary income earned in Dubai? I think the answer is no. There is no personal tax in UAE, assuming that I do not stay beyond 120 days during the financial year. So if you are in salary, it doesn't matter. Okay. Mr. Hemant Mundra asked one question. It's not
so just on the earlier question.
Yes, sir.
The important facet to note is that you are not liable to tax on salary income in India under domestic law. Whether you have the tax treaty benefit or not is not relevant at all. If you have a tax treaty benefit, so if you are more than 183 days in Dubai, you even have the tax treaty benefit. But even assuming that you are in Dubai only for 100 days, because you are traveling elsewhere,
yeah,
it still does not matter. You would not be liable to a tax in India on your salary income.
Correct. So, and then is not the principle of NRI taxation not defined properly that every year and now and then NRI have to twist and turn their head to keep alive their non-resident income out of the gambit of tax net?
That's a very, very interesting question, I would say, Navinji. And why NRI? I think there has been one question which is coming up repeatedly. That does the government need to go on changing tax laws every year? And even as so, just again to without digressing on the answer to the question, if you are an Indian company today, there are some multiple rates of tax available to you. Were you set up before October 19 or after October 19? Are you a manufacturing company or not a manufacturing company? If you are a manufacturing company, are you violating any of the conditions manufacturing things which you are not provided? If you are a company other than that, then if you are not a manufacturing company, are you availing of a tax benefit or not tax benefit? So it becomes fairly complex. And again, in a jocular manner, I can say that's what keeps the profession of chartered accountancy going. But I agree with the question that there is no need for the government to go on making changes. There have been multiple changes to non-resident thing. Last year's original amendment was the worst, which before it got a change, before the finance bill become an act, that would have made global income of people in UAE liable to tax. Thank God. The strong representation from organizations like yours and everybody ultimately resulted in them making the amendment to the finance bill before it became an act.
Yes. So, sir, some of our members joined recently. So I will ask the most famous question. Now, many businesses set up in India can be controlled virtually from outside India. So income of these businesses will not be considered as income from a business control in India.
No, if you are a business set up in India, you are liable to tax in India in any event of the matter because you are a resident. It is only a foreign business which may or may not be set up in India.
Yeah. Mr. Naveen Ajmera said, I joined late, may have missed it, but can you please elaborate on income I am earning in UAE as entrepreneur and having income in India less than 15 lakhs?
So my I guess you should send across the presentation and we can look at it. But I already answered that maybe 3-4 times. So
yeah, so need not to worry about it because it's less than 15. So now what we will do, sir, we will ask members to ask the question live. We will take 4 or 5 questions and please.
My only request would be that questions which have already been answered, if you could avoid repeating unless there is any clarification which is required.
Yeah. CB, you can take the question and please.
Yes, sir.
And unmute the member, please.
Sure. They can raise their hand and we can allow them to speak.
Yeah.
So first one is Mr. Gary Wabi.
Kindly unmute him.
Hello.
Yes, sir. We can hear you.
Yeah, sir. My name is Gary Wabi, and I have income on dividends more than 15 to 50 lakhs per year. I am an investor in India, and I'm also a director of Motilal Oswal in private equity. Now the point is, just now, everything which I get as dividend is directly deducted by the bank and sent to the income tax. Now, I was, because we have a joint treaty with UAE, if that joint treaty agreement is given to each and every company in India where I have shares in, will that deduction be returned back to me or not?
No. Irrespective of the tax treaty, Gary, the dividend income which arises to you in India is liable to tax in India under domestic law, and tax is required to be paid on it. The treaties somewhere along the line reduce the rate of tax, like in the case of Mauritius, like in the case of certain other countries. But otherwise, the dividend income is fully liable to tax in India. There is no exemption whatsoever. Just because there is a tax treaty, the taxability does not change.
Our next question, Mr. KV Shamsuddin.
He's our very senior member.
Delighted.
Sir, please go ahead.
Yeah, I'm asking one question. There are so many people returned to India for good. At the same time, they kept some of their investment in various businesses in UAE. So they are getting regular yearly income from such investment in UAE. But they are directly not involving in this business established long back. This particular person will be a partner in it. So such condition, when the person become a resident Indian, when he receive a regular yearly income from his business in UAE, will it be taxable in India? If it is taxable, is there any exemption? If there is a tax, what will be the percentage of tax?
So when the person returns to India and the person is a not ordinarily resident for the first 2 or 3 years, depending on the number of days criteria, for that first 2-3 years, the income will not be liable to tax in India because it is not earned from a business which is controlled from India, if we can demonstrate that. Thereafter, when the person becomes a resident, then that entire global income is liable to tax in India. There is no specific tax rate. The tax rate is applicable on the global income that a person has and what applies to a resident. One planning which may be possible is that instead of the person directly being a partner, if he forms a company and that company is a partner and that company can be shown as not managed from India, then even after the person becomes a resident, he may not be liable. It's very, very fact specific and will need to be demonstrated in letter and in spirit.
Thank you, sir.
Next, Mr. Ravi Chitnis.
Hello.
Hi, Ravi.
Good evening, Dinesh. Just a quick question. In terms of this new definition, the business income derived from business is controlled or professions set up in India, like, for example, partnerships. So will limited liability partnerships be considered as partnerships, or they will consider as a company and then one can get around that?
No, limited liability partnership are considered as partnership, Ravi. All that it does is that the liability of the partnership is limited.
Okay,
to get
so
over it, one has to be a corporate and
corporate only. Not a, okay, got it. Thanks.
Naveen sir, can we ask one or two questions more?
Yeah, we can have two last question.
All right. Mr. Kamal Gupta, please unmute yourself, sir.
Dinesh, very good evening. The question is specific to the non-citizens. So non-citizens OCI holders, they are basically liable only for the India-sourced income based on India tax, and there is no other liability or no other change of these laws applicable to them, right?
Yeah, unless you are a PIO. If you are not holding a PIO card, then yes, the new changes don't apply.
OCI holders have no impact on the OCI holders.
Yes.
Right. Thank you, sir.
Next one, Mr. Rajiv Hira.
Thanks, Dinesh, for wonderful take. I have one question only. Like, there are a lot of companies which are in UAE, and technically they are 49% shareholder or the minority shareholder, and they intending to draw a salary from the business. So will that salary be constituted as a salary or a business category if it comes into the situation where the management and control comes from India perspective?
So if the management of that business is in India, two things have happened. One is that, and you again are more conversant with that than I am. It has been held in cases, particularly in the UAE courts, that 51% is only for the sake of convenience. Normally, a fixed amount is paid, and the entire profits belong to the 49% shareholder. Although his shareholding is 49, he is entitled to all of the profits. So one has to look at what are those side agreements, etc. If salary is a means of deriving business profit, it will be treated as a income derived from a business control. If it is a genuine salary and over and above that one is entitled to a share of profit, the share of profit will be liable to tax in India, salary income will be not. However, if you are saying that a person is spending more than the specified number of days in India, which is why this whole question is arising, then one also has to consider whether the residential status will continue to be not ordinary resident or a person would have become a resident over a period of time.
Thanks, Dinesh.
I think we should stop with the questions now.
Yes, now sir, we have two questions already in the chat box and we will not take anything new. DMCC, which is a free zone in the UAE, has given zero tax for personal and companies. Isn't this a tax in the UAE, even if it is zero?
Yeah, but why are we asking that question? What relevance does it have?
They said that any country which does not have the tax. They said
I understand, but what is that company deriving income in India? Because if it is deriving income in India, then Indian income is always liable to tax in India unless there is any bill. So I don't know what is the relevance of that question, whether it is liable or not liable to tax.
Okay. And the last is, I think answer is clear, but they want to know from you, are remittances from UAE taxable in India? If yes, what is the annual limit of remittance which is not taxable?
There is no such tax on it.
Yeah. So thank you very much. I know that we have taken a lot of your time, and Mr. Dilip Sinha Sahab is with us, and I will request him to please give the vote of thanks.
Thank you, Naveen ji. First of all, congratulations on organizing such a wonderful, relevant and timely topic for all our members, distinguished members and guests. And Dinesh ji, it's been an amazing, I came a little late, but whatever I have heard, it's amazing in terms of a knowledge and understanding of the tax laws and bylaws, and misunderstandings have been cleared also. So thank you very much for coming in here, and I'm sure there will be many more occasions. I would also like to thank all the guests, the members, of course, they join us and they are welcome, but also the guests who would have joined. I welcome you all. And IBPC is a premier business council under India, Dubai Chamber of Commerce and Industry. So we welcome you to become members of IBPC. And we really like to bring different topics of relevance to all members from time to time. So please give your feedbacks to us. And thank you again, everyone who has contributed to this. And IBPC office, of course, is always there, CB and the team behind him. So thank you. And Dineshji, so nice knowing you. And thank you very much on behalf of all.
Thank you so much. Thank you for having me. And I hope it was time well spent for all your members. Thank you.
Yes, sir.